Buy and hold investment strategy. 6 tools and techniques for success. The buy and hold investment strategy is an investment strategy in which the investor buys stocks and holds them for the long term to make profits. In other words, the buy and hold strategy is about riding out any ups and downs in stock you own rather than trying to swing trade the price movement. There are several tools and techniques that you can rely on to help you take advantage of the buy and hold strategy. Therefore, in this episode, we'll walk you through the top 6 tools and strategies for success in the market. But before we get started, don't forget to hit that subscribe button so you don't miss the future episodes about buy and hold strategy. Let's get started. 6 tools and techniques for success. 1. Stay invested in the stock market. It's very easy to panic and sell stocks whenever there's a big drop in the stock market. However, selling your stocks at the slightest fall or when they're down could be the worst financial decision you can make. When the markets fall, everyone is talking about the next recession or how things are only going to get worse. We get it. Downtrends are scary, but remember that they appear worse than they actually are because of how much they're discussed and analyzed. When you're panicking, first of all, take a deep breath. Since 1900, we've seen some real disasters. There have been many reasons for the market to fall and not rise. The Great Depression, World War I and World War II, Cold War, 9/11 terror attacks, Asian financial crisis, dot-com bubble, the 2008 recession. Through all this, markets have continued to grow at about 10% per year. 2. Automate your investments. We're a huge fan of automating investments. Go into your investment account and set a specific amount to get transferred automatically every month. Automating your investments achieves 3 purposes. First, you're not trying to time the market. Investing each month allows you to average out the gains and losses. It also makes for smoother returns. When you invest each month, if the market is high, your portfolio still grows. If the market is low, you're buying stocks at a comparatively lower price, which will eventually go up. Second, you don't forget to actually invest. By setting up automatic investments, you're truly embracing the set it and forget it strategy. You're not relying on yourself to invest. We all forget to do things. With investing, forgetting to invest will rob you of more returns than any recession will. Don't rely on willpower or your memory. Get it automated so you never have to worry about it again. Third, you can spend freely on the rest. By setting up an automatic transfer to trigger right after you get paid, it never feels like you had the money in the first place. Set up transfers for your investments and savings, set aside enough money for major bills like rent or a mortgage, then spend the rest freely until next month. 3. Use premium market research and analysis resources. Conducting market research can help you pinpoint what stocks to buy or sell, or even discover what stocks will perform well in the future. These 5 market research and analysis resources will help you to achieve this. 1. Motley Fool Stock Advisor. Motley Fool Stock Advisor is the Motley Fool's flagship newsletter service. It's run by advisor David Gardner, who has a team of analysts working to support a fantastic investing style that has beaten the market over the past 10+ years. Motley Fool has been offering stock recommendations and investment advice since 1993. Over 2 decades later, they're still one of the largest financial media companies in the world. 2. Motley Fool Rule Breakers. Motley Fool Rule Breakers aims to beat the market by providing investors with great stocks that have long growth runways ahead of them. 3. Tim's Alert. Good investment advice is hard to find. Okay, so why should you care about Tim's Alert? With Tim's Alert, you will get daily watch lists showing which stocks are best to trade each day and real-time trade alerts so you can learn exactly what you're looking for in each trade. 4. Seeking Alpha Premium. At about $20 per month when billed annually or $30 per month when billed monthly, Seeking Alpha Premium enables traders to get real-time news and fundamental research as well as access to various tools and opinions. 5. TradeSpoon Trade Intelligence Platform. This is a software-based trading tool that can help you find optimal trades in the stock and options markets. Services are offered as information only, not as recommendations or investment advice. 3. Use reports from reputable rating and research agencies. Rating and research agencies gives you access to a wealth of reports and research that could inform your trading decisions. These 4 rating and research agencies are a force to reckon with when it comes to stock market reports. 1. Morningstar Premium. Morningstar's premium membership is an option for individuals who want more in-depth research. This includes a wide moat screener for stocks, a gold medalist screener for funds, access to the analyst ratings and reports, a portfolio manager, and a premium e-newsletter. 2. Kiplinger Mutual Fund Rankings. This tool updates its top mutual fund rankings annually. It shows you the top performing stock mutual funds in 11 categories. 3. Refinitiv. With Refinitiv, you can access an incredible depth and breadth of financial analyst data to make smarter decisions. 4. maxfunds.com. maxfunds.com is a mutual fund information webpage. The website offers investors entertaining and educational resources to help make better investing decisions. 5. Invest in blue chip stocks. The definition of a blue chip stock varies, but it's generally thought of as a big, stable, secure company whose stocks serve as a bellwether for the market. The most common way to invest in blue chip stocks is to add them to an investment portfolio, usually through the help of a broker. Since there are dozens of blue chip stocks on which to choose, you should evaluate the company's performance against the goals of their investment strategy. If you can't decide which blue chip company you want to invest in, you can choose from several exchange-traded funds or mutual funds that focus on blue chip stocks. When evaluating mutual funds, consider the fund's annual yield and its annual average expenses. ETFs are traded like stocks, so consider the share price, but also take into account the expense ratio, which is the cost to manage the ETF. For both funds, you should also consider the stocks included in the fund's account to find what fits your investment strategy. 6. Seek advice from a registered investment advisor. Registered investment advisors, RIAs, are professional independent advisory firms that provide personalized financial advice to their clients, many of whom have complex financial needs. Independent advisors are not tied to any particular family or fund or investment products. So whether you need help with retirement planning, a tax situation, estate planning, or managing assets at multiple places, independent advisors have the freedom to choose from a wide range of investment options in order to tailor their advice based on what's best for you. Independent advisors can help you address the variety of complex investment needs that arise when you accumulate significant wealth. While specific services vary from firm to firm, they're often described as financial quarterbacks, focused on your holistic financial picture. Some advisors are specialists in certain investment strategies. Others can assist you with comprehensive services, such as estate planning or borrowing, the sale of a business, complicated tax situations, trusts, and intergenerational wealth transfer. Is buy and hold investment strategy right for me? As you begin your buy and hold strategy, you must first decide how and when you want to buy your investment. You can choose to buy your investments all at once, lump sum investing, or begin an investment schedule, dollar cost averaging. Dollar cost averaging is the practice of contributing a fixed dollar amount into an investment on a regular schedule. It allows you to enter the market even if you only have a small amount to invest each month. As an example, let's say you invest $300 per month for 1 year in an index fund that covers a broad range of stocks. When values, the price you pay for your shares, are higher, your $300 contribution will purchase fewer shares. When values are lower, your contribution will purchase more shares. Over the course of a year, you'll most likely pay an average price for an investment overall. Therefore, you reduce the risk of repeatedly buying at peak values. With this approach, you can start investing early and take advantage of compound returns. It's important to note that dollar cost averaging does not guarantee you'll pay less for your investments compared with a one-time buy. But investing on a regular schedule helps develop a habit of putting money away. Plus, you can set up automatic contributions to make regular investments. Oftentimes, emotions can sabotage a buy and hold long-term investment strategy. Overconfidence might lead you to trade too frequently, while fear of loss might cause you to hang on to investments that no longer support your goals or earn a suitable return. However, when you invest more regularly and focus on the long term, you can feel confident that you're steadily working toward your goals. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.